In the previous video we looked at a synthetic long put position. In this video I want to create a synthetic long call. So I'll remove the diagram or the graph and just designate this as a call. And keeping in mind, to create a synthetic call, to engineer that particular type of strategy, I would need a long put combined with a long stock. So to estimate, so a long stock position and a long put position. And first thing I will do is I'll go back into the developer tab and down to our function for a put. And the put was estimated using put call parity, and just paste, and we have the same order in terms of variables, so we'll just say put, and that should be sufficient, and it should be about 5 something, so 557, and that looks about right. So if we have these parameter inputs, the premium we would expect to pay for a put option would be 557, for a call option about 1045. Okay, so I said an option trading strategy that attempts to create a long call option requires a long put and a long plus a long stock position. Okay, so to create a long stock position, let's remove this for a moment, just delete out, and to create a long stock position, long stock, it's equivalent to the stock price and then whatever we agree to buy the stock at. So let's say we take the stock price that we've agreed to buy the stock at as being equivalent to 100, just for convenience, and that's the same as the exercise. And let's look at the payoffs. Okay, and let's just graph to see what the payoffs are like. Okay, so that does look like a long stock position, that when the stock price rises we gain, when the stock price falls we lose. Okay, and I said in addition to a long stock position we need a long call, or a long put. Okay, so we're creating a synthetic call and we need a long stock and a long put, and the payoff in a long put is just simply S X F4 minus S. And let's pull that down and let's incorporate that in to a graph just to see. So we're going to add the long put, and the X series here is the stock prices, or the underlying assets value, and the long put payoff we're giving us this, and we'll just visualize. Okay, and yes, we have a long stock combined with a long put, but that put doesn't incorporate in a premium. So just to make it a little bit more realistic, we'll say long put with premium. We've already estimated the premium, so we need the long put position minus the premium, and we hit F4, so we lock the cell reference to the premium and we pull that in, and then we right click and select. Okay, so we might edit as well. That should be a long stock position. And then in addition, we want to add a new series, long put with premium. X series is the underlying asset values, the Y series the payoff on the put, including the premium that you pay, and hit OK. And we can take out the option position that excludes the premium. Okay, now when we combine, let's take that combination, right? It's the sum of the long stock and the long put, and dragging it down we'll get the same set of results. And let's graph that and see what that produces. Select data, add, and we could call this synthetic call or combination is equal to synthetic call, and we'll verify that's the case. Let's take the stock as the underlying and take the Y series to pay off in the combination. And when we look at the combination, let's take it over and stretch and look at the design a little bit. What we observe is that the payoff on this strategy, the red here, looks like a call option, but it's a synthetic call because we produced this payoff, the red, by combining the long stock position with the long green put payoff position. So we'll call this synthetic call. Okay, and save.